Certainly. I will analyze Grupo Financiero Galicia, ADR, GGAL, using Warren Buffett's investment principles and provide a structured report. The main contents of the report are as follows. Business quality and moat. Examines GGAL's business model and competitive advantages using a table. Management quality assesses leadership expertise and capital allocation. Financial strength. Evaluates growth, profitability, and financial health with a table. Intrinsic value. Estimates value using DCF and compares to market price. Long-term prospects. Discusses industry outlook and risks. Final verdict. Determines if GGAL fits Buffett-Style criteria. Comprehensive analysis of Grupo Financiero Galicia ADR, GGAL. Through Warren Buffett's investment lens. 1. Business quality and economic moat. Analysis. Grupo Financiero Galicia (SHAG) operates as a diversified financial services holding company in Argentina, providing a comprehensive range of banking, investment, and insurance products to individuals, businesses, and institutions. Founded in 1905 and headquartered in Buenos Aires, the company has evolved from a traditional bank into a full-service financial group through strategic acquisitions and organic growth. The company operates through 4 main segments: banking, primary revenue driver; Naranja X, fintech, ecosystem, insurance, and other businesses, creating a diversified revenue model that helps mitigate industry-specific risks. 1.1 Revenue model and business operations. GGAL generates revenue through multiple streams, creating a balanced income structure. Net interest income, 45%. Derived from traditional banking activities, including loans, mortgages, and credit products. Fee and commission income, 30%. Generated from credit cards, asset management, payment processing, and other financial services. Insurance premiums approximately equals 15%, from various insurance products including property, casualty, and life insurance. Income from financial instruments, 10%, from investment activities and market operations. The company serves approximately 12,440 employees and operates through an extensive distribution network across Argentina and Uruguay, with the majority of revenue coming from Argentina. 1.2 Competitive advantages and economic moat. Strong brand reputation and long history. With 119 years of operation since its founding in 1905, GGAL has established itself as one of Argentina's most recognized financial institutions. This longevity creates significant trust among customers that new entrants cannot easily replicate, contributing to a durable economic moat. Extensive distribution network. The company operates a wide network of branches, ATMs, and digital platforms that provide convenient access to financial services across Argentina. This physical presence, combined with growing digital capabilities through Naranja X, launched in 2019, creates significant barriers to entry for competitors. Diversified business model. Unlike specialized financial companies, GGAL's operations span banking, insurance, asset management, and fintech services. This diversification provides natural hedging against economic cycles and allows the company to capture multiple revenue streams from the same customer base. Strategic acquisitions and growth. The company has demonstrated strategic growth through acquisitions including Sudacor Litoral S.A., Ijo Docen, Banco de Argentino 1999, and most recently the Argentine operation of HSBC 2023. These acquisitions have systematically expanded market reach and service capabilities. Technological innovation. Through Naranja X and other digital initiatives, GGAL has invested significantly in technology to enhance customer experience and operational efficiency. This focus on innovation helps the company compete effectively with newer fintech entrants, while modernizing traditional banking services. Table. GGAL's economic moat assessment, using Buffett's framework moat component. GGAL. Status assessment. Brand value. 119-year history. Strong recognition in Argentina, strong cost advantage, diversified operations and scale benefits, moderate network effects, extensive physical and digital distribution, strong switching costs, multiple integrated financial services, moderate regulatory advantages, established banking license and approvals. Strong. Despite these advantages, GGAL operates in Argentina's volatile economic environment, which presents challenges to maintaining consistent profitability and growth. The company's moat is primarily domestic in nature, with limited international diversification beyond Uruguay. To management quality assessment, Warren. Buffett places immense importance on the quality and integrity of management when evaluating investment opportunities. GGAL's leadership team demonstrates several characteristics that align with Buffett's preferences for capable and trustworthy stewards of capital. Leadership stability and experience. GGAL is led by Chairman Eduardo Constantine and CEO Sergio Granenko, who bring substantial industry experience and have guided the company through various economic cycles. The management team includes seasoned executives like CFO Lorenzo, providing financial leadership stability. Many board members and executives have long tenures with the company, including Director Federico M. Brown since 1999 and alternate Director Daniel A. Lambias since 2017. This continuity suggests depth of institutional knowledge and consistent strategic direction. Capital allocation strategy. Management has demonstrated a disciplined approach to growth through strategic acquisitions and investments. The acquisition of HSBC's Argentine operations in 2023 represents a significant expansion of market presence. The company has also shown innovation in capital allocation through the launch of Naranja X in 2019 to capture fintech opportunities. The 2017 spin-off of the insurance business into Galicia Seguros S.A. demonstrated strategic focus on core competencies. Shareholder alignment. The ownership structure shows significant insider ownership, with the founding families and related entities retaining approximately 70% of shares. This high level of insider ownership aligns management interests with those of shareholders. A key Buffett principle. Institutional ownership stands at approximately 20%, providing additional oversight. The company pays a consistent dividend, with a current yield of 1.91%, returning capital to shareholders. Transparency and governance. As a dual-listed company, NYSE and Buenos Aires Stock Exchange, GGA adheres to international reporting standards and regulatory requirements. The company provides detailed financial disclosures and has an established board structure with supervisory committees. Performance track record. Under current leadership, GGAL has delivered strong financial results, including impressive revenue growth 31.89% quarter-to-quarter, and EPS growth 639% quarter-to-quarter. The management team has navigated Argentina's challenging economic environment while maintaining profitability and market position. 3. Financial strength evaluation. Warren Buffett prioritizes companies with strong financial fundamentals, including consistent revenue growth, healthy profit margins, high returns on equity, minimal debt, and strong free cash flow generation. GGAL's financial profile presents a mixed but generally positive picture when evaluated through these lenses. 3.1 Revenue growth and profitability. GGAL has demonstrated exceptional revenue growth in recent periods, a characteristic that Buffett often appreciates when sustainable. Quarterly revenue growth, Q-to-Q, 31.89%, trailing 12-month revenue, 5.44 trillion Argentine pesos. Net income attributable to controlling company 2024, 270,794 million Argentine pesos. Earnings per ADS 2024, Rs 108.15. The company maintains solid profitability metrics. Profit margin TTM, 20.31% return on assets normalized, 4.78%. Return on equity normalized, 24.85%. Return on equity TTM, 20.59%. These returns on equity significantly exceed Buffett's typical threshold of 15% plus, indicating efficient use of shareholder capital. 3.2 Debt levels and financial health. From a balance sheet perspective, GGAL appears reasonably positioned with manageable debt levels. Debt-to-equity ratio, 0.74, indicating moderate leverage. Interest coverage. Information not specifically provided in search results. Current ratio. Information not specifically provided in search results. The company maintains a diversified funding base through deposits, debt instruments, and equity, which is typical for financial institutions. While specific liquidity ratios aren't provided, the company's ability to navigate Argentina's economic environment suggests reasonable financial resilience. 3.3 Free cash flow generation. Specific free cash flow figures are not provided in the search results. However, as a financial institution, GGAL's cash flow patterns differ from traditional industrial companies. The company generates substantial operating cash flow from its banking activities, which funds lending operations and investments. 3.4 Capital efficiency. GGAL demonstrates strong capital efficiency through various metrics. Price earnings normalized, 3.40, exceptionally low by international standards. Price book value, 0.82, indicating potential undervaluation. Price sales, 0.67, below industry averages. Asterisk table, GGAL. Financial health assessment, 202-42025, asterisk financial metrics status Buffett standard assessment revenue. Growth, 31.89% Q-to-Q. Consistent growth excellent. Profit margins 20.31% net. Consistently profitable good. ROE normalized 24.85%, 15% plus excellent ROE, and normalized 4.78%, 1% good debt. Equity 0.7 for moderate leverage satisfactory. Valuation metrics PE 3.40, B 0.8 to reasonable valuation. Good for intrinsic value estimation. Warren Buffett focuses on intrinsic value, the discounted value of the cash that can be taken out of a business during its remaining life rather than prevailing market prices. Estimating GGAL's intrinsic value presents unique challenges due to Argentina's volatile economic environment. But we can utilize several approaches to gauge whether the business might be trading at a discount to its intrinsic value. 4.1 Discounted cash flow analysis. Applying a traditional DCF valuation to GGAL is challenging due to Argentina's hyperinflationary environment and currency volatility. However, we can examine various market-based valuation metrics. Market capitalization, $4.81 billion, $5.102 billion. Price earnings normalized, 3.40 price. Book value, 0.82 price. Sales, 0.67. Dividend yield, 1.91%. These valuation metrics appear significantly below global banking sector averages, suggesting potential undervaluation. The extremely low PE ratio of 3.40 is particularly notable, though it must be considered in the context of Argentina's economic risks. 4.2 Morningstar quantitative assessment. Morningstar's quantitative analysis provides additional perspective. Fair value estimate, $43.20. Current price, $29.95 premium. Discount. According to Morningstar, GGAL is trading at a 186% premium to fair value. Though this appears contradictory to the numbers provided and may reflect methodological considerations specific to emerging market banks. 4.3 Owner's earnings approach. Buffett's concept of owner's earnings, reported earnings plus depreciation, amortization, and certain other non-cash charges minus average annual capital expenditures, is challenging to apply to banks. For financial institutions, a more appropriate approach might focus on normalized earnings power. GGAL's normalized ROE of 24.85% suggests strong earnings generation capacity. Tangible book value growth. The company's low PB ratio of 0.82 suggests potential undervaluation relative to assets. Dividend sustainability. The 1.91% dividend yield appears sustainable given current profitability. 4.4 Valuation challenges and considerations. Valuing GGAL requires careful consideration of several unique factors. Hyperinflation accounting. Argentine companies must adjust for hyperinflation. Distorting traditional financial ratios. Currency volatility. The Argentine peso's volatility affects USD-based valuations. Country risk. Argentina's economic instability adds significant risk premium requirements. Regulatory environment. Banking regulations and potential policy changes impact valuation. Based on the available data, GGAL appears potentially undervalued based on traditional metrics, but requires substantial risk adjustments for Argentina's economic environment. The low PEP-BNPS ratios suggest margin of safety, but the country risk is substantial. 5 Long-term prospects and risks. Evaluating GGAL's long-term potential requires examining Argentina's economic dynamics. competitive positioning, and various risk factors that could impact the company's ability to compound capital over the next decade. 5.1 Industry Outlook and Growth Potential. The Argentine financial services market offers substantial growth potential due to several factors. Financial inclusion opportunities. Significant portions of Argentina's population remain underbanked, providing growth potential for basic financial services digital transformation. The shift toward digital banking, represented by GGAL's Naranja X platform, creates opportunities to capture new customer segments. Market consolidation. GGAL's acquisition of HSBC's Argentine operations and other competitors suggests ongoing industry consolidation that could benefit larger players. Economic recovery potential. If Argentina stabilizes its economy through current reforms, banking sector growth could accelerate substantially. 5.2 Competitive threats and market position. GGAL faces competition from several fronts. Local banks, other Argentine financial institutions, including public and private banks, international banks, remaining international players in the Argentine market, fintech companies, digital-only financial services providers. Challenging traditional banking models. GGAL's competitive position appears strong due to its scale advantages, brand recognition, and comprehensive service offerings. The company's acquisition strategy has systematically strengthened its market position. 5.3 Key risks and challenges. Several risks could impact GGAL's ability to compound capital over the long term. Macroeconomic instability. Argentina's history of economic crises, hyperinflation, and currency devaluation represents the most significant risk to GGAL's business model. Regulatory changes. Banking sector regulations and government policies could adversely impact operations. Currency volatility. The Argentine peso's instability affects financial reporting and dollar-based returns. Political risk. Changes in government and economic policies create uncertainty for financial institutions. Credit risk. Economic downturns could lead to increased loan defaults and credit losses. 5.4 Capital compounding potential. For GGAL to compound capital effectively over the next decade, several conditions must be met. Argentina must achieve economic stabilization through successful policy implementation. GAL must maintain its competitive position despite increasing digital disruption. The company must continue adapting to technological changes in financial services. Management must maintain prudent risk management through economic cycles. If these conditions are met, GGAL has the potential to deliver strong returns given its current valuation levels. However, the uncertainty around these factors makes the company's long-term prospects highly dependent on Argentina's macroeconomic trajectory. 6 Final verdict. Buffett-Style investment suitability. Based on comprehensive analysis through Warren Buffett's investment principles, here is how Grupo Financiero Galicia, ADR, measures up against each of the key criteria. A. Understandable. Business. GGAL operates in the financial services sector, which Buffett generally understands well. The banking business model is straightforward, though Argentina's economic complexity adds some challenge. Rating satisfactory. B. Consistent earnings. GGAL has demonstrated strong recent earnings growth, 639% Q2. QEPS growth, see Goodrow ROIC. GGAL's return on equity, 24.85% normalized, significantly exceeds Buffett's 15% threshold, indicating excellent capital efficiency. Rating excellent D-low debt. With a debt-to-equity ratio of 0.74, GGAL maintains reasonable leverage for a financial institution. Rating satisfactory. E. Attractive valuation. Traditional metrics, PE, 3.40. PB 0.8 suggests significant undervaluation, but country risk requires substantial discount. Morningstar's quantitative assessment suggests overvaluation. Rating. Mixed F long-term moat. GGAL possesses a strong domestic moat through brand recognition, distribution network, diversified services, though this is offset by country risk. Rating good 6.1 overall assessment. Grupo Financiero Galicia, ADR, partially meets Warren Buffett's investment criteria, but would likely be too speculative for his traditional investment approach due to Argentina's significant economic and political risks. While the company demonstrates strong profitability, excellent ROE, and apparent undervaluation on traditional metrics, the macroeconomic environment creates uncertainty that contradicts Buffett's preference for predictable businesses. The company might be suitable for investors with a specialized understanding of emerging markets who can appropriately assess and price Argentina's country risk. More conservative investors following Buffett's approach might prefer to avoid GGAL, despite its attractive quantitative metrics, due to the inability to reliably predict long-term earnings power in Argentina's volatile economy. For those interested in the financial sector through a Buffett lens, potentially more suitable candidates might include banks in more stable economies with consistent earnings histories, though these would need to be evaluated based on their own merits against Buffett's criteria. Table GGAL Buffett-Style Investment Suitability Summary Criterion Assessment Explanation. Understandable business satisfactory banking model is understandable despite country complexity. Consistent earnings mixed strong but volatile due to economic environment, good ROIC, excellent 24.85%. ROE exceeds Buffett's 15% threshold. Low debt satisfactory debt-to-equity of 0.74 is reasonable for a bank. Attractive valuation mixed traditional metrics suggests cheapness, but country risk high. Long-term moat, good strong domestic position, but country risk overshadows. Overall suitability speculative to much country risk for true Buffett-style investment.